Are you ready to witness the biggest economic roller coaster of our time? It's 2023, and the U.S. economy is on the brink of collapse, with no signs of slowing down. But amidst the chaos, one market is causing quite a stir: the U.S. housing market. Will it continue to keep its head above water, or will it sink with the rest of the economy? Join us as we dive into the spicy world of the U.S. economy and housing market in 2023, where anything can happen and everything is at stake. Buckle up and hold on tight, because in this video, we're diving into the dark depths of the U.S. economy in 2023, where a looming collapse threatens to shake the very foundation of our financial system. But that's not all. We're also uncovering the truth about the U.S. housing market in 2023, where the game of real estate has become a cutthroat battle for survival. Did you know that in 2023, the housing market in the United States has drastically changed? With rising interest rates and stricter lending regulations, the dream of owning a home has become an uphill battle for many Americans. Moreover, the housing shortage has skyrocketed the prices of homes, making it nearly impossible for first-time buyers to enter the market. But the struggle doesn't end there. The coexistence of a volatile stock market, rising inflation, and unstable job markets have put the U.S. economy on edge. Will this economy thrive or plummet further? Despite the chaos, there's a glimmer of hope as technology continues to evolve. Innovative and affordable housing options have emerged, and the ever-evolving digital landscape has impacted the way we invest, work, and live. In this video, we'll dive deeper into the latest developments in the U.S. economy and housing market that affect our daily lives, what we can expect in the future, and how we can prepare ourselves for the ride. Don't miss out on this analytical take on the U.S. economy and housing market in 2023. The Wall Street Journal conducted a poll of 23 key financial organizations, and the results showed that the overwhelming majority of analysts expect a recession in the United States in 2023, with the result being the loss of millions of employment. Over two-thirds of the almost 24 organizations polled anticipate a decline in the U.S. economy in 2023. These businesses include trading companies and financial banks that conduct direct transactions with the Federal Reserve. 2 of the 23 companies predict the recession will not hit until 2024, while the other 5, Credit Suisse, Goldman Sachs, HSBC, JP Morgan Chase, and Morgan Stanley, think the United States will escape a decline entirely. Prediction agencies believe that consumer expenditure will drop as Americans spend down their assets, interest rates on loans rise thanks to the Federal Reserve's bold monetary policy, and banks tighten their financial regulations. The Consumer Price Index in the United States reached a recent high of 9% in June 2022. Prompting the Federal Reserve to increase interest rates at their quickest pace since the 1980s. CPI statistics from November show inflation is at 7.1%, suggesting the sharp rate hikes have had little impact so far. The Federal Reserve has raised interest rates rapidly from practically nothing in March 2022 to their present level of 4.24 to 4.5%. And while inflation has slowed since its June high, it has not slowed enough to cause the Fed to slow down. Fed officials, disappointed by inflation's tenacity in the face of rate hikes, have promised to keep increasing rates while maintaining them higher until inflation falls close to the Fed's 2% goal, as assessed by the Core Personal Consumption Expenditures Price Indicator. In November, Core PCE, Price Index less variable areas like food and energy, came in at 4.7%, which is significantly higher than the Fed's goal of 2.0%. Federal Reserve officials have stated in recent economic forecast summaries that they anticipate a final Fed funds rate of 5.1%. This rate would be the greatest level before hitting a limit and subsequently falling. The Fed predicts that with such rates in place, the jobless rate will rise to 4.6% in 2023 from its present 3.7% and remain at that level throughout 2024. Most analysts polled by the Wall Street Journal expect unemployment to rise to over 5% before leveling off. Such a high percentage of unemployment would cause economic hardship for millions of people in the United States. Before we dive deeper into the U.S. housing market in this video, please take a moment to hit that like and subscribe button if you are enjoying the video so far. SMB Law Group conducted a comprehensive analysis of 10 top investment banks' 2023 market forecast projections, finding that the majority were negative. Barclays, in particular, predicted that 2023 would be a challenging year. But how does this all link to the U.S. housing market? Let's take a look at some key data points. In 2023, the U.S. property market faces a pivotal time amid varying predictions for its destiny. Due to solid demand and historically cheap borrowing rates, the property market has experienced unprecedented development in recent years. Experts have begun raising the alert that the U.S. property market may be on the brink of a collapse, but these fears have yet to materialize. The annual increase in house prices slowed in 2022 as rising mortgage rates and falling costs dampened demand. There will likely be a drop in house values in the immediate future as a result of elevated borrowing rates. In any case, experts agree that the recession will be mild if it materializes at all and won't cause the same level of pervasive joblessness as the Great Recession. Fewer householders will default on their debts as a result, and those who are having trouble may choose to sell and recoup some of their losses. As mortgage interest rates approach 6%, many already stretched households are taking a back seat. Some people are being priced out of the housing market altogether because of rising interest rates and house costs, while others are choosing to wait it out for fear of a crisis. The outcome is fewer sales, less competitive bargaining, and fewer offers above the asking price. It's become necessary for many homeowners to lower their asking rates. The United States has fallen far short of meeting its housing needs over the past decade. According to Freddie Mac, the nation needed more than 3.8 million dwellings at the end of 2020, right as the property surge was picking up steam. While single-family house development picked up during the epidemic, contractors backed off in 2022, with construction starts down 16% in November 2022 from the same period a year earlier, and construction licenses down by 22% during the same time frame, according to statistics from the United States Census Bureau. National Association of House Builders chief economist Robert Dietz predicts a further 15 to 20% drop in the single-family house starts in 2023, followed by a gradual recovery in 2024. This suggests that the inventory is contracting. In a market where supply is extremely limited and where values for homes continue to rise, this could have far-reaching effects. Dr. Dietz predicts that the percentage of 25 to 34-year-olds who still reside at home with their family members will increase. Currently, this number stands at 20%. The expectation is that mortgage rates will fall in the case of a crisis, bringing back purchasers who were not affected by the job loss. As a result, house purchases will rise, which is good news for the industry as a whole. The property market has the potential to aid the economy in emerging from a downturn. Although the U.S. housing market will undergo some shifts in 2023, most real estate experts do not expect it to collapse or cause a slowdown. To avoid another Great Depression, the mortgage industry has made steps to get rid of all the poor loans. Most Americans are expecting to escape another 18 months of struggle due to the extreme housing scarcity. In the case of a crisis, a rise in house purchases could even help the economy recoup. Housing demand from millennials acts as a cushion against a market decline. Housing is a top priority for millennials and Gen Z. As of this past July 2019, 166 million millennials and younger Americans were eligible to purchase a house. As the National Association of Realtors reported, the percentage of June transactions attributable to first-time purchasers rose to 30% from 27% in May, but fell from 31% in June 2021. Most first-time purchasers are under 40, pointing to a large customer base and strong demand, particularly in light of the current shortage of available homes. Since the housing supply has been flat for the past decade, prices won't fall. Generation Z will be 30 years old in the next few years, and they will have greater financial stability to buy houses than millennials did at the same age. This indicates that housing demand will continue to be high, if not increase, despite the shortage of available homes. Analysts predict the housing market will continue to be healthy for the foreseeable future because of the low inventory levels that are pushing up house costs. Inadequate construction over the past decade has contributed to a severe supply-demand mismatch, which has driven up housing values dramatically over the last 2 years because of the epidemic, and will continue to do so for a considerable amount of time as builders work to catch up. A healthy housing market would have a supply of about 6 months' worth of houses on the market, or the amount of time it would take to sell off all available properties at the present sales pace. Although the December 2021 supply was only 1.7 months, the present market only has 2.9 months, showing a substantial disparity in favor of buyers. No indications point to a housing market collapse in 2023, although high borrowing rates are expected to keep demand falling across the year. The property market's rapid expansion caused by the pandemic will cool off somewhat. This situation has made it harder for prospective buyers to get ahead, and although the market will eventually recover, this could take time and be a challenge for many home buyers. Buyers must be mindful of the current economic conditions and invest strategically while remaining patient. Have you ever seen its deep consequences? What if the market does not recover and eventually crashes? What will you do if that happens? How will you manage your finances if property prices go down? These are all valid questions, and no one answer fits all. However, everyone needs to be aware of the current market conditions and how they may affect their home purchasing decisions in 2023. Despite the short-term market uncertainty, many opportunities are still available for prospective buyers in the medium and long term. It is possible to find good deals and great investments, but it is also important to be mindful of the risks. The key is to weigh all your options carefully before making any decisions. This was a quick overview of the current housing market situation in 2023 and its potential implications. Thank you guys for watching. As always, please make sure you hit that like and subscribe button if you enjoyed the video, and leave a comment below letting me know your thoughts on the present housing market situation. Do you think it will recover, or will there be a housing market crash? Stay tuned for more updates. Until then, keep investing wisely.